Thank you very much. And I'm going to hand over now to Susan.
Thanks very much, Jane. Is that all sharing okay with you?
Yes, it is.
Thanks everybody for joining us today. And as Jane said, this is going to be a bit of a whistle-stop tour, but the aim here is to make sure that you've got the headlines. So if you need to pick up with anything after today, then at least you know what you might be, what questions you might be asking. But before I get into that detail, I just want to introduce the British Business Bank. And the British Business Bank is the UK government-owned economic development bank, and it's our mission to help the finance markets work better for smaller businesses, and to drive that growth in UK businesses. And that green economy is part of our core focus as well. So it's the work that we do to help improve or enable access to finance for smaller businesses. It's important to say at this point that we're not a regulated bank. We're not a retail bank as you would generally know. So we don't lend or invest directly. We work behind the markets. We work alongside the lenders and investment partners out there, and currently about over 200 partners that we work with. And that's a really important piece because we don't lend or invest directly, we're in more of a neutral place. And that means that I can talk through the options that might be available to you without having anything to sell, in inverted commas. So I think that's a really important aspect to mention right at the beginning. In terms of what we're here to do, that unlocking money and driving growth for smaller businesses is key. And when we use that word sustainable there, it's sustainable growth. So it's like good growth. So making sure that there's the right sort of finance at the right time, and you know what you might be looking for in order to manage and grow your business. The backing innovation piece tends to be, but not exclusively, about looking at equity finance for more innovation-led, technology-led companies, but as I say, not exclusively. Unlocking potential is about us looking at where there are gaps in finance, and that might be geographically, it might be sector, it might be stage of business growth, it might be the profile of the founders who are underserved by the finance community. So some of that might be gender, ethnicity, whatever. So it's really important for us to try to open up the markets and work with, we call them delivery partners, to get for businesses to get access to money. And then underpinning all that, as I mentioned earlier, is that green economy that everybody is looking to make sure that we do as much as we can to help businesses green up their business and work towards that net zero target as a country. We operate with expertise and finance, putting that into the market to try to crowd in the private sector. And right at the beginning of a journey, and I'll come on to this, startup funding right through to venture capital funding in equity. And there are multiple partners in all of those areas. And some of these delivery partners it's not so much the specific partners, it's what they do. I'll explain shortly. So it's our place to look at crowding in is a term that's sometimes used to encourage the private sector to address some of the challenges and some of the gaps in the market. We work with over 200, I mentioned, providers, some of which you'll be very familiar with, the high street banks and others, and some you won't be familiar with at all, but they are out there, and the information is all available on our website for the partners that we work with. So that's a very quick introduction to the bank and where we sit and why I'm in a good place to just help try to make sure that you've got as much information as you at your fingertips as you can. So that introduction to finance, what we're going to cover today is different ways to fund your business with non-dilutive funding, i.e. Debt finance as well as investment finance on equity, improving that knowledge of the funding landscape and explaining where you can get more information. And a reminder here that we don't provide advice, we're not regulated, we're here to support and help you explore the financial options that might be right for you. And I'm one of the senior managers working in the southeast of England, and I have counterparts across all of the nations and regions of the UK, in case you're dialing in from outside the area. So today, I mean, you'll be aware finance options run from business grants through to debt and equity. Today we'll focus on debt and equity, but in terms of grants, whether they may be local small grants from districts, borough councils, some are available through those. And I know Buckinghamshire Business First manages some of those projects for helping businesses green their business and reduce their carbon emissions. And then there are larger grants available through the likes of Innovate UK. So that's not a part of the market that we work in, but it's worth understanding more if it's sector, region specific, to do with a particular activity that you might want to get access to finance for. So moving on to that introduction and getting behind the headlines of finance, this is a really sort of introductory piece about understanding what you need the finance for. And these are just some of the questions to ask yourself before you go out to find out what finance might be right for you. And it sounds a really obvious thing to say, but why are you looking for the finance? What is it for? How much money are you looking for? What do you need it for? The timing of that. And with that, then we'll cover this broadly, is what's your compelling reason for needing that finance? Because some of the potential lenders or investors are going to want to understand exactly what's different about you and what makes your business special, if you like. So understanding your market, and they will all ask for your financials and whether they're realistic, and we'll come back to some of that a bit later on. But in terms of that reason for looking for finance, that's a really important piece at the beginning, because if it's working capital finance as opposed to investment finance, then debt finance might be the way to go for this. So I'm going to look at some of the terminologies here, some of the products, some of the core characteristics of the different types of debt finance. And many of these terms you'll be very familiar with, some less familiar with. But in terms of products, then availability of term loans, commercial mortgages, asset finance, overdrafts, which is that line of credit that we'll look at. And then there's invoice finance, which has changed over the last few years. And then also leasing, hire purchase, contract payment plans as well have all changed. So those characteristics, if you like, of debt finance are just making sure that you understand that it's all about repayments, understanding what time period you might want that finance to work through. You don't relinquish any ownership of your business, but it might be secured against an asset. It might be property, it might be other assets that you have in the business. Personal guarantees might be in there as well, and we'll come on to some of this detail. So there's certain product terms, but also certain characteristics of debt finance that good to understand exactly what you're looking for before speaking to somebody, because the more homework you do, the better placed you'll be to get the right finance for you. Coming to right at the beginning of a business journey, the one thing that I need to mention here is startup loans, and some of you may have taken advantage of startup loans. They are government-backed personal loans for business use, and from £500 up to £25,000 per business founder. And the advantage of these is that it's where you would be unable to secure finance from traditional banks. And startup loans have been in place for about 10 years, and they were specifically put in place in order to enable some of the much smaller businesses, startup businesses. First 3 years is, we're saying startup, but first 3 years of trading. And we work with, we call business support partners that will help you through that application. They'll look at personal survival budgets and look at your business plan and everything else. So a really good place to go right at the beginning of your journey within the first 3 years. And an important thing that's missing from that slide is that there's a fixed interest rate, which is 6%, which is a really competitive interest rate, and that's fixed over up to 5 years of a term of that. So startup loans, there are national support partners as well as regional, and they will take you through that process. So that's something definitely to look at. You all will have to, if you're applying for that, there's a personal credit check because it is a personal loan for business use. So there are some processes and procedures to go through there, but the information is available on our website and our partners' website as well. So that's right at the beginning of the journey. Then moving into some of the other quite familiar terminology, overdrafts, which is an arrangement with a bank to borrow to manage the peaks and troughs in your business. And the idea is that most of the time you'll be above that line in terms of being in credit, and then some of the time you will be below the line and need to access additional finance. So it's smoothing out those peaks and troughs, and some of that will come to do with when you're buying stock, for example, and you need to pay before you're selling. Some of it just might be a seasonality. If you have a very seasonal business, then sometimes overdrafts come into play. But the one thing to remember there is that they are most likely to be repayable on demand. So if you're looking at more permanent, consistent, confirmed debt finance, then very much look at whether an overdraft is the right thing for you. Interest rates can be variable. Security still may be required on an overdraft, but they may be relatively short term as well. But the advantage is, as I say, quite flexible, and you might pay an arrangement fee, but most likely that you'll pay interest only when you're in debit for an overdraft. If you're looking at property, then a term loan or a business mortgage might come into play there. And term loans are, as they say, a loan for a certain period of time, more medium to long term, enabling your business to purchase something to add value or longer term value to your business. And business mortgages, purchasing premises, so that might be something that you choose to do depending on your business model and whether that's a core part of your business model. In terms of the advantages there over overdrafts, there's more consistency and more long-term certainty with a term loan to enable you to make a longer term investment and spread the cost of that investment over the term of that loan. And if it's a longer term loan, you may well get lower interest rates than a short-term loan. You will be making a commitment over a long period of time, and in many cases securing that loan against assets. So that's where looking into the market and understanding what's right for you is really key to understand what you might be exposing your business to be able to service that loan. Coming on to asset-based lending, and I think this is one that many businesses don't fully appreciate what it can be used for. So there's one thing about purchasing assets, new assets, but also existing assets. You may be able to borrow against existing assets. So there's two ways of looking at it. And a quick example here, where a business that was a life sciences business that I knew a number of years ago, they were looking at opening up and expanding with a new laboratory. And the first discussion that this particular founder had with me was about looking at business angel finance. which potentially may have been the right thing to do to grow his business. But when it came to purchasing assets to kit out his new lab, the likelihood is that asset finance might have been right for him, because that guarantee sits against the value of the assets that he was going to be buying, and he hadn't appreciated that that was an option. So he could have gone down the wrong line for him, and potentially sold shares in his company when actually there may have been a different type of finance that was right for him. So asset-based lending, looking at larger asset purchases, it does smooth out that cash flow, because you can spread the payback to buy that asset, or as I say, you can borrow against existing assets as well. The disadvantage, as you'll appreciate, is that if there's any default, then potentially that asset is at risk, which if it's a core part of your business, then you need to be mindful of that. But there's lots of examples where asset finance might be right, even for very small businesses that might still be in their startup phases. And some of the more obvious will be small cafes, small retail. They might, in a similar way to that business I just mentioned, setting up a new laboratory, then a cafe is going to have refrigeration and other assets in order to start that business. So that is something to think about what is at risk if you have borrowed against that. The other side of it is looking at any debt needs to have a plan to be able to service that debt. So if in that retail or hospitality example, then the business plan needs to stack up to fund the business, as well as and part of that business plan is financing those assets that are needed to deliver that business. So one other disadvantage here is that lenders are most likely to value your assets lower than the value that you paid for them. There's natural depreciation there, but that's something to look at. So if you were looking at buying again, then you may well, if you're defaulting and a lender takes ownership back of that asset, then it may not pay off the value of the debt that's outstanding. So as with all these things, it's advantages and disadvantages depending on what you're borrowing against. And assets in that sense can be physical or non-physical, because a particular line of finance might be available for certain intellectual capital. If you've got strong patents on a technology or a science-based business, there may well be that value of that patent against which you might be able to borrow money. So lots of things to think about in terms of that asset-based lending. Another working capital finance product is invoice finance, and invoice finance has changed quite a lot over the last few years, and it's not all about financing your whole sales book anymore. It used to be very much that, but now there are providers that will finance individual invoices, as well as helping smooth out that cash flow by collecting invoice payments upfront without you having to wait to receive payments from your customers or clients. There's certainly advantages for cash flow in doing that, and if you're looking at financing your invoices, your sales book, then it's not risking other business assets. In terms of where invoice finance has got to now, is particularly smaller businesses that have large businesses as their customers, then sometimes you can finance just a small amount of invoices. And unfortunately, there are smaller businesses sometimes are really exposed when their customers are larger companies, where they take a long time to settle their invoices. So for just a few of your invoices, that might be a way to go. So definitely something to look at, and it keeps pace with growth. So the more you're selling, the more finance that you get straight back into your business without having to look at other sources of finance. Disadvantages, as there will be with anything, that you need to just look at where a credit policy is with a particular lender and what the costs might be in terms of what you'd be taking off the value of that invoice. But think about the speed with which you can settle your invoices without having to worry about chasing those debts. So part of that process, to a lesser or greater extent, can be outsourced, and sometimes it will be done white label, if you like, without anybody else knowing that it's you having outsourced that, or sometimes it might be a third party that's very visible to some of your customers. So there's a number of different ways of looking at that in terms of debt, in terms of invoice finance. Other types of debt finance that you will probably be aware of is peer-to-peer lending, and Funding Circle, for example, is one of the most well-known. But peer-to-peer lending, just like invoice finance and many other sources of finance, has changed hugely over the last few years. At the beginning of Funding Circle, it was very much peer-to-peer, you and me lending money to small businesses through a platform. Some of that has changed, and there is more institutional money in there. So the model of some of those platforms has changed, but there are other ways to look at peer-to-peer, and some are more what's the right way to describe it? Sort of gift-led lending. So an individual lending money against a future purchase. And some of this is the origins of some of that peer-to-peer, is where small businesses, sometimes hospitality and product companies, might say, well, I'll lend you some money, and when your product is launched, I might get a discount or some free products at the beginning of that journey, and I've helped fund that journey for you. So there's different things to look at there in terms of peer-to-peer, and I've got some links at the end that will help you identify some of those platforms. And there's various sizes and secured, unsecured, so a lot to look at there as well. In terms of export finance, if you're exporting, trading overseas, then some of those facilities are looking at how you can mitigate any risks of overseas customers, and looking at guarantees and bonds to be issued by banks to allow customers to call in that bond from a bank if your customer doesn't fulfill their side of the deal in order to pay you. There are things called letters of credit. There's another form of guarantee that you will receive payment on time, and then the banks step in to cover shortfall if payments can't be made. So all of this reduces the risk for you as a seller if you're selling to overseas companies. And UK Export Finance is one of the government's agencies to help British businesses sell overseas. And they work with the banking community to try to make sure that solid, sound British businesses aren't compromised in terms of growing their businesses internationally for the sake of making sure that they get paid for the products or services that are sold through that. So again, there are some I think I've got some links to information about UK Export Finance. I will pause there because I have raced through debt finance, and before I just dive into some of the equity stuff, I will pause there, Jane, and look to you if anybody has any questions at this stage about debt finance, anything for clarity. I will do my best to answer. If not, I shall move on. We haven't got any questions in the chat, have we, Jane?
I was to say, I don't think there are. I haven't seen any. I'm looking to see if anybody's got their hands up, or would anybody like to interject or anything else like that before we move on?
Sounds like I've bamboozled everybody. There we go. So, no, lots to
Well,
go
answered
through. A
everyone's
lot of
questions.
yeah.
So
Sorry, what did you say there,
I
Jane?
just said you probably answered a lot
Oh
of
well,
people's questions.
hopefully that's the way it's gone.
I suppose I have a question.
Who was that talking? Is that
This
Paul?
is
Yes.
Paul. Yeah.
Go. Yeah.
To do with asset finance and patent specifically.
Yes.
Practicalities. Because I do have the patent is the asset I have. There's another one as well, but it's primarily the patent side of it. Where do I make contact? Now, I understand you're backing the backers in that sort of sense.
Yes.
Where would be the contacts I would make in order to follow that side through?
That's a difficult one for me to answer because I can't make introductions to potential sources of finance. But I think the important thing is to know that there are funders that will look at your patent as an asset. And one of the things that you might want to do is talk to a business finance broker, because they have visibility of a wider spread of the market. And they may well be able to see and to speak to some of the challenger banks, some of the alternative lenders, to understand how that asset can work in your favour if you're looking to borrow against it. So that's because some recent research from the British Business Bank is now telling us that almost 60% of lending goes out from the non-high street banks. So the vast majority of lending now is through other lenders. So, and many of which you may not be aware of. So a corporate finance broker is a really good place to start if you're looking at something. And if they don't know specifically, or they don't work in that area, they may well be able to, because they're likely to be FCA regulated, they may be able to refer you on. So a little bit of help, but not specifically answering your question because I can't there, Paul. Okay. Simon, you've got a question.
It's just a point, actually. I'm a business finance broker.
Okay.
Known very well to Jane Dell. If I can help in any way to steer you in the right direction, or even point you elsewhere if I can't help you, then I have access to around 49 lenders, many of which use the British Business Bank to back up the funding. So if there's anything I can do to help, then please don't hesitate to send me a message.
Yeah.
Yes, please. That's a great contact for this event.
And Paul, we have some others as well as Simon as well. So yes, we can help you with at least finding some of those brokers.
Brilliant. Thank you.
Great. Thanks very much. Okay, thanks for that. So I'll now just move on to look at some of the other forms of finance, which is equity finance, and why your business might consider using equity funding rather than debt. They're not mutually exclusive. I think that's a really important thing to say. Increasingly, businesses are looking at different types of finance running in parallel, because you may look to external investors to help fuel your growth, whilst at the same time you might be buying new assets for the business and using some asset-based lending. So very much different aspects might come together. So for equity finance, if your business is expecting higher growth, and it's a more scalable business, investors buying equity in your business are looking for that scalability, because that's where their return will come from. And those indications that you have strong interest already in the market, or you've already secured a grant, or there is sales traction already, something that is demonstrating that you're beyond what I would call a sort of a lifestyle business, a sole trader. You have that scalability built into your business model, and you need some investment to fuel that fast growth, to get some first mover advantage, for example. And then that is what some of those investment and equity investors will be looking for in your business. So in terms of equity investment, then those sources of those running through from the earlier stage. So the first, often after friends and family, this is because often you will effectively buy a stake in your own company, so you'll be seen as some of those founding shareholders of your own business if you're a company limited by shares. And then the first external investor over and above friends and family will be those business angels, private investors. And the important thing about business angels is that it is their money, into a personal investment. Venture capital is moving into more institutional money, but it's still looking at risk capital in terms of those earlier stage companies as well. And in many cases, but again, not exclusively, is finding the right equity investor for you might depend on a sector, the geographical area that an investor works in and wants to work with local businesses. They may look to put some more time into your business. They may look to put expertise in your business, and that happens more in the business angel and venture capital area. In terms of private equity, that's going higher up the value chain, and you would definitely have much more traction. It's institutional money at that stage. So that might be, for the audience here, correct me if I'm wrong, but that might be much further down. And then just like there is peer-to-peer lending, then equity crowdfunding, places like Crowdcube and other platforms. That was one of the first. There are other platforms there. And then working right through to an IPO, an initial public offering, is the first time a private company would look to sell shares on the public markets. So that's sort of working through right from the beginning at business angels through to an IPO, taking a company public for the first time. So the characteristics of equity investment over debt investment is that investments are buying a stake in your business. They are buying shares in your business. And I often, perhaps being a bit pedantic, when I hear people say you're giving away shares, you're not giving away, you're selling a stake in your business. And that is perhaps just picking up on a detail, but I think it's a really important detail in terms of the way you think about an external investor, is they are buying a stake in their business and in your business, and in that the return that they're looking for might be short term, might be longer term. So they might have expertise to bring, they might have networking, as I say, and they may have some sector expertise. And the one important thing here is this process takes time, and don't underestimate the time that it might take. Too often I've seen businesses, and I'm sure Jane and her team see businesses that say, both on debt and equity, it's the beginning of the month and I've got a really important contract coming up and I need capital, or I can't meet my payroll, or I'm going to run out of my grant funding and the company finances are falling off a cliff and I need some equity investment in the next 2 months. It's always going to take longer than you think, and it really is a concerted effort to put a plan of action together to go out to equity investment, particularly the first time. And you could say that it takes a disproportionate of management time from founders and leaders of small businesses, because you're potentially taking your eye off the ball. But if you're looking for those for that risk finance to come into your business, it's an important part, but you can manage that process with the help of some advisors as well. So coming back to some of those more specifically, those sources of finance, that real early stage, so post friends and family, business angels, really suited to businesses scaling. And importantly, I think at this stage is thinking about a business angel seeking an ongoing relationship with you as the founder of a business. because they might not get their return from your business, i.e. being able to sell their shares either back to you or back if you exit the business through a trade sale or however it is exited, then you might be working with these individuals for many years. So that personal relationship is really important. And if you get on well with them and they're bringing extra added value, it's a really key point of change for a small business to bring in that bringing in a private investor, sometimes called high net worth individuals, sometimes called sophisticated investors, sometimes called all of those things. So that phraseology is used across the piece for business angels who are investing their own money. And that, I think, is an important mindset to think about, that they might have a spread of investments for small businesses, or they may only be investing in one business. The downside of investing in only one business is they have so-called all their eggs in your basket if they're doing that. So there may be quite a bit of stress that goes behind that. Business angels are going to be looking at working with businesses at slightly different parts of the process. Some will look at proof of concept there. Some will look, like Paul's business, will look at what sits behind that business, patents, other intellectual capital. Some will be very mindful of what happens further down the line when more investment is made, because if more investors come on board, then their stake will be diluted. So just understanding that dilution, but as is often said, it's better to have a smaller part of a bigger pie. But it's really important to understand what dilution means for you and for your early investors, because the valuation is likely to be much lower at the beginning than it is later on. So those investors at the beginning need to understand that, as do you, and they will look to support you as you go through that business journey. But as I mentioned, it will take longer. It won't take 2 months. It might take 6 months. It might take longer, because you need to find the right investor for you. And there's quite a bit of work to be done on that. Moving into the venture capital, this is also relatively early stage, and as the word venture, so it's still looking at that venture stage, but most likely without taking a controlling stake in your business. And most business angels and VCs will also want you to keep that controlling stake, particularly at the beginning of the process. It means you've got skin in the game. You've got an incentive and a driver to make sure that your business succeeds, and you can put as much effort as you can into making it work. VCs will likely to want some representation on your board. Sometimes they're called observer seats, depends how active they are, but they would have to look at being mindful of not being shadow directors and making decisions, but they might be able to just bring their expertise to your board as well. So understanding where the gaps potentially are in your board might be helping you make a decision about where the right business angel or VC might come from. But venture capital companies might look for following their own money, further investment rounds, and what's happening in the market at the moment that we're seeing, which has happened really after the hiatus of investment activity through 2020, 21 into 2022 during the pandemic, where interest rates were really low and there was lots of activity in early stage investment. That has settled down and has tailed off. And what we're seeing now is there are fewer investments being made, but they're higher value investments. And also what I hear from business angels and VCs is that they are taking less risk. So if it's the business angels at the beginning of your journey, they would look to businesses in their portfolio that look like they're becoming more successful more quickly. They are perhaps more likely to invest in their existing portfolio than taking a risk on a new company. And VCs will also look for further investment because they want to pursue their investment. And as your success carries on, then they would look to follow that as well. But each have different investment theses. So understanding what an investment thesis is for a particular angel investor or VC firm is really important. Otherwise, you might go down some blind alleys. And some of the obvious examples, I worked with quite an active investor with in a different role before I joined the bank, with a business which was a food business. And they worked with a very active angel investor who'd successfully grown and sold a food business. But he used to say to me, there's no point me speaking to software companies, technology companies. I know about food. I know about retail in food. I know about supply chains in food. It sounds really obvious, but you can waste time with not knowing what the likelihood is of an investor saying, that's one for me, I'll put that at the top of the list, as opposed to disregarding it because it really doesn't fit with their experience. The disadvantages with any of these is possibly a long process, and there will be fees involved. But I think one thing to bear in mind here, which I would certainly encourage you to make sure that you think of legal and finance fees as a positive, and it's that cost benefit, getting it right, making sure that all your due diligence is done, and making sure you're really well set for investment will avoid any valuation points being knocked off your potential investment. Private equity, crowdfunding, I won't go into the detail on that, but crowdfunding, make sure that you're looking at regulated platforms, and for private equity is really further down the line with institutional, which may or may not be relevant to some of you here. One important thing to just look to wrap some of this up is that the mindset for lenders versus equity is quite different, and your business plans and financial plans will be different depending on what you're going for. A lender will be looking for a plan that demonstrates that you can service a loan, and an investor, in a nutshell, wants to know how they will get their money back at a point in time in the future. You won't be able to agree it because it will perhaps be determined against certain milestones. So quite different in terms of the mindset, but that's what sits behind it, because it depends what the purpose is that you're raising the finance for. I won't go into a lot of this detail because I want to make sure that there's time for some questions, but the work that Jane and her colleagues do is very much understanding how to prepare yourself best for finance. And this is some of the things that is really important: what your problem is, what you're trying to solve, how you measure success, where you are in that funding journey. Are you right at the prototype stage? Have you got a minimum viable product? Have you started trading or not? Will all be determinants of preparing and then accessing finance in order to help you. That business plan, the checklist there, none of that will be a surprise to any of you, but it's all about being really clear about what the issue is, really clear about where that source of competitive advantage is for your business. If it's a very busy market or it's a very traditional market, what makes you different? It doesn't have to be step change technology. There are hundreds of cafes out there, and we sort of all know why we might go to one cafe over another. It's not that they're looking at doing something hugely different. It's that secret ingredient that's sometimes difficult to pin down. Those financials, really important to get your financials in place and understand all of those projections, making sure they're realistic, making sure they will stand up to scrutiny. Those key performance indicators, it might be margin, it might be stock turns, whatever it is for your business, just making sure that they are realistic. And all the time, businesses fail on cash with not having the cash in the business. So some of it is for external investors, but more importantly, it's for you to be able to manage your business well. There will always be credit assessment processes that lenders go through, but the more you can understand your own financials, then the more that you can have that robust discussion and perhaps secure that finance on really good terms. Coming to the end of what I'm going to say before I open it out, we have a business guidance website. There are hundreds of articles and guidance tips, toolkits available on our website, and also on this one there are lots of ways to find potential support. Growth hubs, accelerators, growth programs like Jane, they're there. I mentioned about UK Export Finance. There's a UK Export Academy. If you're looking at angel groups, UK Business Angels is there, private equity, and then some of the business groups as well. And if you're looking for sources of finance aside from the main banks, if you're struggling to find finance, then the community development finance institutions that just snuck in there at the bottom. I will pause for breath there because that was a really quick canter through a whole bunch of information, but we can certainly share these slides, and hopefully I've at least flagged up what you either do know or don't know that you can go and investigate further. Phil, have you got a question? I'm going to stop sharing my slides at this point. Thank you.
Excuse me, sorry. Thank you very much. That's a wonderful run through of a whole range of things. I run a business of providing financial leadership, business modeling, finance coaching to SMEs, and would just like to kind of make two points. One is, we encounter businesses where it's too late. So getting your position in order, some of the things that you mentioned on that business plan slide, the financial statement slide, modeling those out. So, and I think earlier you mentioned about having a plan to repay the debt. That's critical. We encounter businesses where, yes, unfortunately, things are just too close to the line. And whilst people have reached out for help, it's too late. So that just one point, but just another was, I didn't hear it. It may have been before I joined, but what the tax planning for the business can have if you're on a marginal decision between whether to get debt finance or equity finance, debt has tax advantages in terms of your tax planning processes. So can swing a marginal case in the direction of debt finance versus equity finance.
Thanks for that, Phil. That's a good point. And also that's just reminded me, if you're looking for equity investment, external equity investment, then make sure that you check out the Seed Enterprise Investment Scheme and the Enterprise Investment Scheme, which is tax advantages for personal investors. And they would, in most cases, expect your business to be assured in advance that you're eligible for them to work through those processes, which gives them huge tax advantages. And we have one of the most beneficial tax regimes for small business investment, but it means it helps at the risk finance end of the market. So SEIS and EIS.
Yeah. I'm not affiliated in any way, but I can recommend Seed Legals as a platform that's extremely informative around SEIS and EIS related matters.
Thank you.
Thank you.
Any other questions?
There's always going to be things that we won't have got to, and Phil's just talked about that with tax and personal tax and business tax, and if you're the owner and the founder, and even the merits of directors' loans and how they look and all that it's all really important to take that financial advice. And I would encourage you to think about strategic financial input as early as possible, and there are many sources of part-time fractional finance directors now, and it might only be 1 or 2 days a month, but some of that is, think of it more of an investment than a cost, because it might stand you in good stead, particularly if you're a scaling business looking for finance to rapidly increase your growth.
Susan, I noticed there is a question in the chat from Hope. Is there guidance on how to conduct personal P2P, so peer-to-peer sample documentation, for example? Hope, I don't know if you're with us still. Is that the question? Can I just clarify with that?
Is there guidance on how to conduct?
Yes,
that's
the question.
Could you just, I'm not sure, do you mean peer-to-peer lending or peer-to-peer investment?
Peer-to-peer lending. So if I wanted to borrow peer-to-peer,
yeah,
I'd want to formalize that. Do you offer documentation and advice as to how to go about doing that?
We don't offer the advice, but certainly I'll have a look to see whether there's any of the more specific information about presenting your case on a peer-to-peer lending platform. And I think it's sort of looking at what your pitch would be to a potential lender or investor. I think that's where you are. And different platforms will expect things in different formats. Sometimes it's video also these days. Sometimes it's a PowerPoint pitch deck. Sometimes it's in a format according to their particular platform. But the one thing on most of the platforms is, what I do know is they will always look for there to be some existing investment. If you go onto a platform and you have 0 already committed, you are almost very unlikely to secure investment. I heard somebody say recently, especially in equity investment, think about the crowd platforms as topping up your existing investment. So if you've already got 50 or 60% of investment agreed, committed, letters of intent, whatever it might be, then think of it as that top up, because it ends up being nobody wants to take that first step. There's something somebody thinks put something in the chat. Thanks Phil.
That was Phil.
Yeah, I'm not sure if that completely answers your question, Hope, but I'll do a bit of digging around, and there may well be other sources of that guidance to help you put a good proposition, proposal, pitch, however you want to describe it, to some of those platforms.
Thank you.
Does anybody else have any questions for Susan? Okay. If not, then we'll be here for another couple of minutes. I would just like to take this opportunity of thank you, Susan, but I would equally like to just talk about that aspect, that wider aspect of support, whether it is financial or not. And that's where, just reminding you about some of the aspects that Buckinghamshire Business First can offer and support all of you as business owners. And so really it is that aspect of that whole aspect of business support that we're here for. It is that huge aspect of a wide variety of support for lots of different things. And as we've already mentioned, there is this aspect of our own growth program that we have that is available for business owners, and it is this aspect of there is a huge amount of support available, including a lot of financial support as well for all different types of businesses, helping you to understand even further than what we've gone through today with all of those various aspects of finance, and helping you put that business plan into place and all of those. So really that is something or other that many business owners actually might want to consider further. We also have support around the net zero aspects as well. And we also have for many of you might well be interested in some future Power Hour events that we have coming up. And so they will be coming on up very shortly. It's about exporting around skills and things like that. So I would very much like to say, do use us, and that's going to be a very important part of your own finance raising journey or development of the business and helping you to thrive and to grow. So use us, and we're here to help and support you, because that is ultimately what we do. So thank you very much, and we would very much like to say thank you very much to Susan. We'll be here for a couple of more minutes to answer any further questions if you would like to do that, whether it's about general business support or about actually the aspects of finance. So thank you so much, Susan. It's been a great hour. Can't believe we've actually covered an awful lot. So any further questions from anybody?
I'd like to make contact with Simon Barrett and Phil Walker afterwards.
Okay. I think they've already put some details in the chat, actually, I believe, Paul, but we can send some details across to you separately as well if you can't see those now.
Thank you.
And I've just put a note as well, is that we'll send the slides. I'll get those across to Jane or Paula, and we'll make sure that they're sent on. It's not an exhaustive list of resources, but there's some there to help you as well as speak to Jane.
Okay. We'll get some details across to you, Paul.
Thank you.
Anything else, anybody? Well, I think you probably may have 30 seconds back in the diary. We finished momentarily early, but Susan, a fantastic hour, lots of information, really helpful. And one final very quick question. If there was one thing, what would you say is the common mistake for business owners in raising finance? Is there some little parting gift that you could, nugget of thought?
I think the one sentence which probably Phil mentioned, was it Phil that mentioned earlier, is not doing enough preparation and not leaving enough time. Is just, that is it. It will stand you in good stead, and it will always take longer, probably both for debt, but particularly for equity finance. Is just be really well prepared. You just make sure that you have answered the questions likely to be asked before somebody else asks them, and that's really it. Preparation is everything.
Yeah, I would actually concur, and it is that aspect of it takes longer, but being well prepared will just
absolutely
put you head and shoulders of other people who are not quite in that position. So yes, definitely, and we can help and support people to be able to be prepared as much as we possibly can. So yes, please reach out if that's of interest.